All right, ladies and gentlemen, I hope you're having a wonderful weekend. Today, we're going to talk about something interesting, and given the nature of where the markets are at, this question came up a lot. If people think, or people have been asking me, do I think the market is going to crash, or what's going to happen and how it's going to happen? I've touched on this video or this topic before, and we're going to go over the bonds. We've talked about that on the live stream. I'm going to show you guys something related to the yield curve, give a brief explanation. I encourage you guys to go watch that other video I made if you want a more in-depth approach on it, but we're going to talk about it briefly here. But I want to talk about exactly how the stock market is going to crash in 2019, or really starting 2019, and then really we'll see the effects in 2020. Now, I guess to rephrase everything and how to put it, even though this is the title of the video, this is just what I think. This is what I believe. This is my opinion. And at the same time, if you've watched any of my videos, you guys know I'm very, very versatile. Once data changes and some things change, and that's the beauty, which I love about the financial markets, things can change quickly. And even though one situation may develop, it really, the markets can adjust to it, and it doesn't always have to be that bad. So if things change, I will update you guys, but this is kind of what I'm expecting. And I guess it's more along the lines of that. With the volatility, we're approaching a very, very crucial zone, and I think if things developed, and they've been showing to develop quickly, we could see something happen. So I'm gonna go over this. Make sure you guys drop your thumbs up on the video if you find this helpful. Make sure you are subscribed. We post a nightly watch list every night on this channel, Monday through Friday when the market is trading. Well, on Sunday too, it's gonna start. So tomorrow, so get ready for that. And best of all, we are live Monday through Friday, 30 minutes before open. It's the first link in the description, and also pinned in the comments. You can watch me trade live along with Chad, my good friend. He is very, very helpful there to answer all your questions. He could source the news faster than any news site you've ever seen. He's just a stand-up guy, man. He's great. And if you're in the market for a pony, I think he could help you out as well with that. And I said this on the last time I discussed the yield curve and how this works. Share this video if you find it helpful. I think it's kind of cool for people to be aware of this stuff, and it definitely helps out the channel here. So just, yeah, post it on Facebook. I post it anywhere. Post it on YouTube. I don't know. But let's get into it. So the two things we're going to discuss here is the yield curve and the bond rates. And they're important now because even in October, if you guys saw what the markets did the first time, or even like January or December, even March too, we saw yield curve inversion, but not necessarily. And I'm going to talk briefly about what this is, but to simplify it, really, because in the context of where we're at now, I'm not, if you don't want to watch this whole video and get the basics and recap, really the only thing I'm looking for here is this right here, the 2-year and the 10-year, and what I'm expecting to happen and what I believe is going to cause the next downturn, or where we're going to really, this will be the pivot point when things are really, when, if people ever ask me the question, do I think it's going to be more volatile? Do I think the market's going to crash? I will say yes if this occurs. And what that's going to be is this 2-year and the 10-year inverting. And what that means now is, as you see here, the 3-month all the way to the 30-year, these are the bond rates. But essentially an inversion would mean when the 2-year bond rate is higher than the 10-year bond rate. So the 2 years right now at 1.649, the 10 years at 1.745. It's about a 15 basis point difference. So that's actually a very, very small spread between the two. And what I'm expecting to happen, and this is why I'm bringing this up, because this could happen literally by the end of next week if the bond movements keep moving like they have post the latest Fed cut, which is the first time we saw that in like 11 years since 2008. But what would happen, and what I think it would cause the next downturn, or give confirmation, not necessarily, I guess, and that's the thing, this is a result, not a cause. So if this happened, I think this is showing us that, wow, there is definitely something wrong, and there's two events that would need to occur. One, the 2-year would go higher than the 10-year, and that could happen faster than we think, or what I'm kind of starting to anticipate. And then what would happen is, after the 2-year and the 10-year invert, they're going to start cutting rates again. And then if they cut rates again now in this context, given what Jerome Powell just recently said, it would not show a mid-cycle adjustment and would actually be pointing towards a rate cutting cycle. So pretty much if the 2-year inverts with the 10-year and they cut rates again and then they keep cutting, that is going to start showing now economic weakness. And I could put my tinfoil hat on and say that will be the start of a downturn, and everybody would know it, or at least the people in charge of making policy, which would be at the Fed. So that's pretty much it. Hopefully that helps. Make sure you guys are subscribed, and I love you. No, I'm just kidding. But that is really what I'm saying to look for. Now let me explain to you the logic why. Now this is where it goes through the yield curve and what we see, because now the point is, if you look now, some people would say that the yield curve is inverted. And if you even look here, starting again This is what, January, December 2018. It started end of January, really. So April, it was like March or April now. And the markets, they started to get a little bit shaky there again. But right when the curve started to invert, pretty much when the curve flattened, in October through December, the curve flattened and the 2-year became the same as the 5-year, and I think the 2 and the 5-year inverted as that started to occur. And then the real inversion, where now you saw short-term rates higher than long-term rates, that occurred in March, April, May. That's when people started to get panicky. And now some people would say that that would have caused the crash, or that is where it gets bad. And I disagree with that. And I'm going to tell you guys my theory. This is what I talked about in the video, because now really my theory goes like this. When you see the curve invert and then come back to normal, so when it inverts and then normalizes, the moment it normalizes is your signal to short the market, or that the economic downturn or the economic cycle is about to turn. Again, I'll explain the underlying monetary policy aspects of that, but at the end of the day, some would argue that already happened, and what we just saw could honestly void all of my theories, but it made sense to me why it has not, and that's where I'm kind of seeing how things are developing now, because the 3-month was already higher than the 2, 5, 7, and even the 10-year at one point. However, that is not an inverted curve. You see here, it's still saying normal. Like, even though you could look at it mathematically speaking, the slope is still positive. It's a normal sloping curve. So despite the 3-month being higher, because the 3-month was a lot higher, and then what do? They recently cut. That's why you could even see now the short-term rates go down. And that's something to highlight, as we talked about this and I discussed in that video. The 3-month bond rates that you even see here, this is the Federal Reserve. The Fed controls the short-term interest rates. That's what they're putting out, the base interest rate. So you'll notice that the 3-month is on par with the Fed funds rate. And even if you go back in time, like take a look here, if you notice as we go through the years 2013, 14, 15, it looks like somebody was stepping on it. And that's because that was the Fed. That's when we had 0% interest rates, and that's what was, that's the Fed there. So despite us seeing the 3-month higher, and then now that they cut rates, my original theory would dictate, okay, that we should see the crash coming, but it just didn't align well with me, because this wasn't a real yield curve inversion. So that's what I'm saying here. What makes sense right now in the current scope of things, it's much more likely that once the 2-year drops below the 10-year now, imagine this 10-year coming down here or right below the 2-year, that's going to really flatten everything. And most of the points now on the short term will be higher than the long term. That would truly become inverted. And now literally we just had the first rate cut in 10 years. So now if that happened with the current rate of things, it would make sense to see a cut with the Fed. And again, I'm going to explain that logic again, but now what would cause this to go down? It's the same scenario we're seeing here with bond rates, where global bonds recently, ever since the Fed decided to cut, they have been plummeting because people are piling into bonds. When more people buy bonds, demand goes up for that, or when the demand for bonds goes up, the yields drop. So again, if the stock market continues to drop right now, coming into the next rate cut, or because of the trade wars or whatever, if the market cuts down, there's more tensions, people are going to start piling into bonds to protect their money. And also, people are going to start anticipating future rate cuts. If you anticipate future rate cuts, you're going to start buying bonds now, because these are the highest yields you're going to get. So they're going to start rushing into those. So that could quickly drop these rates. And then again, too, if the market's down, or even if it's just naturally expected by the Fed, they'll cut rates, and then that would truly be our signal that something is wrong and we're going to have a downturn. So let me give you the quick theory again. I think the video I made first time was about 30 minutes or so on this. It has to do with the yield curve, and why? It's because my theory is more along the lines that I believe that the government is all-knowing. I think it's like Jesus Christ, knows everything. And, well, honestly, it's a political mandate for them to give people jobs and to make sure everything's in control. And the Fed wants to, there's no coincidence that Powell says he wants to continue the economic expansion. And that is what their goal is. And they know truthfully when is best, or they have they're the first people getting the information, and they know it's up. It makes sense. That's why, I don't know if it makes sense why they cut, but again, it makes sense why now, despite that cut, it doesn't really show anything wrong. But once the yield curve inverts, that shows a bunch of global money in the largest market in the world positioning towards expectation in the future. And then once you see the Fed confirm it with the short-term rates, that's when everything is going to go down. But let's take a look at the yield curve, because they call the yield curve the most complicated mystery to solve in economics. I think they call it the unexplained mystery or unexplained predictive power of the yield curve, because if you guys have probably heard this, and I have a bunch of videos explaining the yield curve and whatnot, but every single recession or downturn has been preceded by a inversion of the yield curve. And now a lot of people don't know how to read it, and this is my theory, again, like I'm saying, but really watch what happens here. You can see this is 1999, and you can see the curve is messed up, and isn't it crazy how high rates were? But it looks all over the place. But then you start to see as the stock market goes up, and now it's why would the Fed raise rates? You can see the rates start to go up, but then now, like, take a look here, pause. We're coming to the top here, even though your 3-month is below the 30, and actually at this time the 30-year didn't even exist. It was extrapolated from the 20-year. It was still the highest, but look at the 2 and the 10-year were actually inverted, and that's it. And the stock market was at all-time highs, and that's the next thing. Take a look. The minute the curve inverted or flattened, now it's normal. You see in the bottom right here it says flat. It didn't invert till here, and then even though it had a little dip, the market continued for another few months, another half of a year, up until August. And then it inverted fully. But then now what started to happen here, it doesn't automatically crash when it gets inverted. So let's keep it playing, and you see now it's starting to move. It's further inverted, but then what starts to happen? Boom. So this is the Fed. Some people, and this is where people say sometimes the Fed is too late, but I think it's when the Fed, sometimes the market reacts and the prices are too high, and the Fed will sometimes react either, I think, appropriately in time. Some people argue too late, but that's my signal, because then the minute they cut, as you see, the curve goes from inverted to then the cuts start to begin. You see in the bottom it says normal, and now the curve starts to normalize, but the market proceeds to drop about 50%. And look at how much they cut the rate. And again, this is my theory that this is the Fed controlling economic expansion, because when do they want to start raising rates? It's just like we saw here. It's when prices get too high. When prices get too high and they believe that the money supply and economic environment is creating an environment that is encouraging speculation, and asset prices get too high, that is a danger to the fabric of the economy, because that's what happened with the Japan and a lot of, and again, East Asian financial crisis. It is when asset prices grow at a faster pace than real income and wages. So again, the key there is real income and wages, how much people are making, because if prices go too high, people aren't making enough, but they're leveraging all this money. If there is a decline in asset prices, it could lead to a very negative downturn that would become even harder to fix. So that's why they begin to raise rates to tighten up the economy. And I've said this before, that's what they did. So take a look. It comes back there, 2001. It's crashing. They lower rates pretty low, and then it starts bouncing in 2003. And what do they start doing? You see the 3-month there. Boom, they're raising it up all the way, because now things are getting back to normal. But then that's what's funny, because this crash and what they're doing now with rates and then the policy, they made a bunch of cheap money down here. So the rich people and the people who are aware of this or had access, they started buying it up. And guess what they started buying? Real estate. This is 2005. So think about real estate prices in 05, 06. Now take a look at the curve. It starts to flatten here. And even right before here now, you see it's normalized in it, even though it's relatively flat. This is 06. Even though it's 06, if you go a little bit further here, what starts to happen? Boom. The 30-year drops, and now that inverts the curve, because that was actually the first time now they introduced the 30-year bond in 2006. They no longer extrapolated it, and then and guess what? That's an auction. If you guys remember what happened on Friday on the live stream, they auctioned it off, and again, the yield that produced inverted the curve finally fully. But then take a look, 2006 in the stock market, guess what? Everything kept ripping. And it hit new highs, and it's still flat, and then boom. But as you see here, it really gets inverted there, even though it's saying flat. And that's the thing. It could go flat or inverted, but once you see the Fed intervene and cut rates, that is the signal that, okay, something's wrong. And again, think 06, 07, real estate prices are going crazy. Speculation is somewhat encouraged by the current economic state. The Fed wanted to start slowing that down in 06. It took about 2 years. Then boom, they started cutting. And even when they started cutting, the market dropped a little bit and then came back up to highs. Sound familiar? And then what started to happen? The markets, they started really cutting as the market started. And this again, you'll start to see it keeps going and going. And then they had their emergency meetings. They kept cutting, and boom, you see what happens there. Goes back to zero, and everything's dandy and okay. But then it looks like we start to repeat the same cycle now. So boom, but the thing is, they've already started the cutting. It's kind of like '01 here, where it goes up, but then they start bringing it down a little bit. But it's now how do they react to it? So again, the key is, though, if they keep cutting, in my opinion, without that inversion, it's kind of interesting because we flattened a little bit. So maybe the same signal exists, but once that 2 and the 10-year goes, or if they do an emergency meeting, I think that will become the beginning of the next cycle ending and potential stock market crash. So hide your kids, hide your wife, tell a friend. Oh my God. No, but as you guys see, the more you know, the better to prepare yourself. It doesn't mean the end of the world. It doesn't mean the apocalypse. This is economics in a cycle. I'm excited to see how it plays out because I'm excited to see how they handle it. I'm excited to see how the people in charge do, even Jerome Powell and the policies and stuff that they're going to put in place. But overall, this is where you have to differentiate, where some people will lose their ass trying to make money off of a crash, whereas the key thing is to protect yourself. So understand that's the whole idea of wealth preservation and investments and assets and all that. But there's the info. Do what you want with it. Speculate however you please. I encourage you, be safe. I encourage you not to be doom gloom, wish bad upon people or the markets or our great country or anything of that nature. And understand you're watching history in the making. Take it easy and enjoy life. And if you feel like it's overwhelming and you feel like you need help with anything and it's going to get crazy, tune in on stream, youtube.com/the stock market. We'll be live Monday through Friday, 30 minutes before open. Whether the curve is inverted, whether they cut rates, whether they raise rates, anything, you can watch it all live, baby. So I love you guys. Show some love. Let me know what you guys think about it. And make sure you check out the other video. I will put it in the description there for you guys. The more you know. Let's go.